Okay, so now let's look at Chapter 2, Journalizing Transactions, Posting to the General Ledger, Using T accounts, and Preparing a Trial Balance. We had used the accounting equation for these same entries earlier, but we learned through looking at the accounting equation that's a cumbersome way to keep your records. So now we're going to look at how companies truly do keep their records. First, let's look at preparing journal entries. E-Learning Agency receives $30,000 in cash from Sheena Bright, and the business issues common stock to her. So the two accounts that have been involved with this transaction are cash and common stock. We know from looking at the accounting equation that cash, or an asset, is increased with a debit. So since we're increasing cash, we want to go ahead and debit cash. We put cash first in the journal entry. You always put the debit first in the journal entry. Secondly, we'll indent common stock a bit in order to differentiate credits from the debits. And we learned from looking at the accounting equation that when we look at common stock and we're increasing it, we're going to credit it. So we're going to credit common stock for $30,000. We talked in class about how it is difficult to get things right in the accounting records if you get the journal entries wrong. So spend a lot of your time looking at the accounting equation, looking at these transactions to make sure you understand debits and credits with respect to the various accounts, and also to memorize in case the accounting logic isn't quite caught up to you yet. Next, Smart Touch Learning paid $20,000 cash for land. So the two accounts involved are two asset accounts. One is cash, one is land. Cash is going down, land is going up. Since these are both assets and we debit assets for increases, we're going to debit land for $20,000, and since the asset cash is decreasing and decreases are denominated with a credit, we're going to credit cash for $20,000. Smart Touch then buys $500 of office supplies on account. So now we have office supplies an asset, and we're buying it on account. We're not spending cash, so accounts payable is going to be involved. So since office supplies is an asset and it is increasing, we are going to debit office supplies $500. Next, we know that liabilities increase with a credit, so we are going to credit accounts payable because accounts payable are now increasing. Number 4, collected cash of $5,500 for service revenue that the business earned by providing services to clients. So this was cash was received and service revenue is involved. So cash is going up, it's an asset, so we'll debit it. It goes first in the journal entry. Secondly, we know that revenue, because it's part of owner's equity and it increases with the credit, we're going to increase revenue by crediting it for $5,500. Again, we are indenting all of the credits, so it's easy visually to tell the difference from the debits from the credits, and this is what is done in actual accounting records. 5, perform services for clients for which the company will pay later. So they performed some services for clients, so that's revenue, but they didn't get cash. They got a promise to pay or accounts receivable. Accounts receivable is an asset, so we're going to increase the asset with the debit, and we're going to increase revenue because with the credit, because revenue increases are denominated with the credit. Next, we're going to pay cash expenses, so this is expenses and part of owner's equity, and these will be debits, these expenses, because it's decreasing owner's equity, which is traditionally credit-based, so these decreases for expenses or debits for expenses decrease owner's equity. So we had office rent of $2,000 and employee salaries of $1,200. So we're debiting rent expense, we're increasing expense, so we're debiting it. We're debiting salary, we're increasing an expense. To do that, we use a debit. We are decreasing the asset cash, so we're going to credit it. Next, we paid $300 on the accounts payable that was created in transaction 3. This involves accounts payable and cash. Accounts payable is going down. Accounts payable is increased with a credit, So when we're paying down accounts payable or reducing it, we must record a debit. And since cash is going down and we decrease an asset account with a credit, we're going to be crediting cash. Next, we collected $2,000 from a client in transaction 5. So cash is involved as well as the accounts receivable that we had with the client. So these are two asset accounts. So cash is going up, we'll debit that. Accounts receivable is going down. They no longer owe the $2,000. So we're going to credit accounts receivable to demonstrate the fact that accounts receivable is going down or decreasing. 5, we're going to pay $5,000 in cash for dividends. This will be dividends in cash. Dividends are increased with a debit. It's under owner's equity. Cash, the asset, is being decreased, so it'll be credited. Next, we're going to pay 3 months of office rent for $3,000. $1,000 per month times 3 months. So since this is more than just 1 month, it is a payment of something related to future benefits. We're not going to call it an expense. We're going to determine that this is an asset with future benefits, which is the hallmark of a description of an asset, and we're going to call it prepaid rent. So we are increasing an asset, so we're going to debit prepaid rent. We're decreasing the asset cash, so it's being credited for $3,000. Next, we're going to pay employee salaries, and since employee salaries only benefit the current period, it's considered an expense. So salary expense, $1,200, decreasing cash, credit $1,200. Usually for journal entries, it's very easy to determine what is going up or down when you look at cash. It's the one you probably see the most and the one you'll intuitively begin to understand. When you begin to build a journal entry, if you're confused, use the cash transaction, the cash portion of the transaction to help you figure out whether the other side is a debit or a credit. So let's look at this. We purchased a $60,000 building in exchange for a note payable. The building will benefit the business in the future, so that's the definition of an asset. So this will be an asset. We're increasing it, so we'll debit it for $60,000. We're increasing the liability called note payable, so we're going to credit that for $60,000. We received a contribution of furniture the company did with a fair market value of $18,000 from Sheena Bright. So an asset, furniture is going up, will benefit more than one period, and Sheena Bright will receive common stock in exchange for the asset. So a common stock is under stockholders' equity. It is increasing with a credit. We're going to receive the telephone bill and pay this expense next month. So since we're not paying it, cash is not involved, and since it's related to a particular month, this month, it's not benefiting future periods, so it's going to be an expense. So our debit will be to utilities expense because we're increasing an expense, and our credit will be to utilities payable because we owe the money, so it's increasing a liability. Next, we're going to pay in salaries of $1,200, salary expense debited, cash credited. A law firm engages Smart Touch Learning to provide e-learning services and agrees to pay $600 in advance. Smart Touch Learning will receive the cash but has not yet performed the services. So this is akin to NFL teams when they get the ticket revenue before they perform the services or play the games. In this instance, Smart Touch has received $600 that will owe back to the client if it does not perform these services. So the cash is involved, but also now a liability. They haven't earned the revenue yet because they haven't performed the services. So cash is going to increase with a debit. Our credit is going to be to a liability account called unearned revenue. As services are performed, we will debit unearned revenue and credit regular revenue in order to place it on the financial statement, the income statement. Right now, as a liability, it's on what financial statement? The balance sheet, right. Next, we're going to collect cash of $8,000 for service revenue that the business earned by providing services for clients. So cash and revenue are involved. Cash is increasing or debiting for $8,000, and revenue is increasing or credited for $8,000. So let's look at these transactions and let's look at what's happening in the T accounts. So we have cash for $30,000, cash is being debited for $30,000, and common stock is being debited for $30,000. Again, it's easy to fill out the T accounts if you've got the journal entries correct. You just have to be meticulous and make certain that you just do it in order, and just be careful when you do it. Next, we had the land we purchased for $20,000. Cash is going down by $20,000. So on the right side, the credit side, we have the $20,000 for the payment of the land, and then we see land has been debited for $20,000. Next, we have office supplies, which is an asset, $500, and the fact that we haven't paid for it yet, we owe it on accounts payable, so we see the accounts payable credit increasing for $500. Cash for revenue earned, the amount of $5,500. We received cash. We're debiting cash $5,500, and we're going to credit revenue $5,500. And if you get lost in the way this is being set up, the numbers from the journal entries are being put to the side of the individual transactions so you can trace them back and forth. Next, we have accounts receivable that we got instead of being given cash for the revenue, the services that we performed. Accounts receivable is an asset, so we're going to debit accounts receivable, and then we're going to credit revenue, number 5. Next, number 6, rent expense. So we have rent expense here, salary expense here. We paid cash, so we're going to be crediting cash here. Next, accounts payable. We're paying on accounts payable, so our cash is going down. We're going to credit cash, and we're going to be debiting accounts payable, showing that we're paid less, we owe less on accounts payable. Next, we're going to collect on our accounts receivable, so our cash is going up, and our accounts receivable is going down, so we're going to credit that. You see the 8 here and the 8 here. Next, we're going to pay dividends, the amount of $5,000. We are decreasing cash, so we're going to credit cash. And again, like I said, if you know the cash transaction, you can think about this. Well, if we're crediting cash, so then we must have to debit something. Traditionally, if you think about it, it's usually an expense, but in this instance, we were paying dividends. And yes, that makes sense because dividends are increased with the debit. So over here, we have dividends increased with the debit. Next, we have prepaid rent, an asset, and cash is being spent, an asset. So prepaid rent went up and cash went down. Salary expense, cash went down, salary expense went up with the debit. Building is going up with the debit. Note payable is going up with a credit. So here we have our building, and here we have our note payable. Furniture was invested in the company by the owner, so furniture went up by $18,000. She was given common stock for the furniture, so now common stock has gone up by $18,000. Utilities expense, we didn't pay it, so we have a utilities payable. This is our utilities expense. Now we have utilities payable here. We have some more salary that we paid, salary expense and cash, cash, salary expense. Then we have the cash that we received, but we didn't perform any services yet for it, so it's a liability under earned revenue. Remember, all of these liabilities are on the balance sheet. All of these assets are also on the balance sheet. These will be on different financial statements. Next, we have revenue that we earned and we were paid in cash, so cash increased by $8,000 and revenue increased by $8,000. So next, we will balance our T accounts. So we said we use the same 3 steps each time. We add up all the debits, add up all the credits, Take the smaller from the larger, and that's our balance. So our balance is $12,200. You can see that this is a little bit easier to manage than adding up and subtracting all of the cash transactions here. So this represents the general ledger. Everything related to cash is in one spot. Next, office supplies, no need to balance there. Accounts receivable, $1,000. Prepaid, $3,000. Furniture, building, and land. Accounts payable, we can see that $300 was lower than the $500, so our balance is $200. Utilities payable, unearned revenue, notes payable. Common stock, we just added all of those up. Nothing here, no debits, no credits. I'm sorry, no debits. So all we had to do is add the credits. Add all the debits here. So now we have everything in our T accounts. So now let's look at these T accounts and prepare a trial balance. So this is just going to be a recapture to see if you have the correct normal balances for these accounts and if all of your debits equal all of your credits. So cash, we're just going to put it in the spot whether it's a debit or a credit balance. Office supplies, accounts receivable, prepaid rent, furniture, building, land, accounts payable, our first credit we see here, utilities payable, unearned revenue, note payable, common stock, dividends is a debit, revenue credit based, expenses debit based, expenses. So now we're going to add up all of the debits and all of the credits, and we can see that we were in balance. And also, too, from this, you could use the trial balance to prepare your financial statements. So for the income statement, you would take your revenue minus your expenses, you would get net income, and you would add that to beginning retained earnings, and then you would have a subtotal, and from that you would deduct dividends, and then you would have ending retained earnings, and then you would add that to common stock, and that would be all of your owner's equity under the balance sheet. All of these, the accounts payable, utilities payable, unearned revenue, and note payable would all be your liabilities on your balance sheet. And all of your assets on the balance sheet would be the cash, office supplies, accounts receivable, prepaid rent, furniture, building, and land.